Hello. In this video, we'll discuss how accountants analyze business transactions with the help of T accounts. In prior videos, we learned how to analyze business transactions using the accounting equation. Assets equals liabilities plus owner's equity. And we recorded 12 initial transactions for Eli's Consulting by entering the amounts in the accounting equation table. Recording transactions in an equation format might work when the business has very few transactions and only a limited number of accounts. But imagine how difficult it would be if the business had a lot of transactions over many years, and different accountants would have to share the same ledger book. Also, the business might not want all accountants to have access to all transactions. An alternative to recording transactions in the equation format is the use of the T account. The T account is an important visual tool used as an alternative to the fundamental accounting equation. And just like it sounds, T accounts look like a T with the name of the account above the horizontal line. The left side is called the debit side, and the right side is called the credit side. It takes a bit of practice and repetition, not unlike learning a foreign language, to remember what accounts increase with debits and decrease with credits, and what accounts increase with credits and decrease with debits. But for now, remember that assets increase with debits on the left side. It might also be helpful to remember that assets are also on the left side of the balance sheet. Assets decrease with credits. Liabilities and owner's equity accounts increase with a credit on the right side. These accounts are also located on the right side of the balance sheet. Liabilities and owner's equity accounts decrease with debits. Here's a visual look at asset, liability, and owner's equity accounts and how they increase and decrease. Assets increase with debits on the left side and decrease with credits on the right side. Liabilities and owner's equity accounts increase with credits on the right side and decrease with debits on the left side. So let's walk through the 12 business transactions for Eli's Consulting and analyze them by using T accounts. In the first transaction, Trade and Eli gave $100,000 from his personal funds to the business. When we analyzed this transaction using the accounting equation, we said that the business's cash, which is a property or asset of the business, increased, and that the owner's equity also increased by $100,000. So how do we write this transaction using T accounts? Well, cash is an asset account, and we learned that assets increase with debits. That is why we write a debit on the left side of the cash account. The amount of the business owes to the owner also increased, and we learned that owner's equity accounts increase with credits on the right side of the T account. So let's write a $100,000 credit into the owner's equity T account. Remember that all transactions must always balance. Otherwise, our accounting equation would not hold true. And so with the first transaction behind us, let's take a look at the next transactions. For our second transaction, Eli's Consulting Services issued a $5,000 check to purchase a computer and other equipment. So our computer and other equipment increased by $5,000. And at the same time, Eli's Consulting issued a check, which means that cash decreased. Both accounts are asset accounts, and we can see here in the below graphic that assets increase on the left side with debits and decrease on the right side with credits. So for this transaction, the equipment account increases. That means we increase the equipment on the left side with a debit of $5,000. Cash decreased. Cash is an asset, and assets decrease with credits on the right side. So we'll write $5,000 onto the right side of the cash account for the third transaction. Eli's Consulting Services purchased office equipment on account from Office Plus for $6,000 for the third transaction. So our equipment account, which is an asset, increased. Assets increase with debits, and that's why we'll write a $6,000 debit on the left side. When a business buys on credit or on account, as Eli's Consulting did, we call that an accounts payable. So when we pay on account, accounts payable increase. Accounts payable is a liability account, and liability accounts increase with credits. Therefore, we'll write a $6,000 credit on the right side of the account for our fourth transaction. In the fourth transaction, Sanchez purchased supplies so that Eli's Consulting Services could start operations. And for this transaction, Eli's Consulting issued a check for $1,500 to Office Deluxe Inc. to purchase office supplies. So two things happened here. The business now has more office supplies, and two, that the business now has less cash. Let's start with the first part. Office supplies is an asset and increases on the left side with a debit. And so we'll debit the account office supplies for $1,500. The second part of our transaction must therefore be a credit because all transactions have at least one debit and one credit. And each transaction must balance. And the first part of our transaction was already a debit. So we already know that we'll need a credit to an account, but we can also look at our table. Eli's Consulting issued a check, so cash decreased. Cash is an asset, and assets decrease with credits. Therefore, we're going to credit cash for $1,500 for this transaction. Our fifth transaction is about Sanchez, the office manager who decided to reduce the firm's debt to Office Plus by $2,500. Eli's Consulting had previously purchased equipment from Office Plus for $6,000. We're now reducing that debt by $2,500. That means that the accounts payable are going to decrease. Accounts payable are liabilities, and liabilities increase on the credit side and decrease on the debit side. So we're going to debit accounts payable for $2,500 and reduce the accounts payable. Every accounting transaction must have at least one debit and one credit entry. We've already figured out the debit side of our entry. Now let's figure out the credit. We decreased our cash account, and cash is an asset account and decreases with credits. Therefore, we're going to credit cash by $2,500. Let's now look at the sixth transaction. Eli's Consulting Services issued a check for $8,000 to pay rent for the month of December and January. Payments in advance for rent are considered prepaid expenses, and prepaid expenses are an asset of the company. So we need to debit prepaid rent because our asset prepaid rent increases and assets increase with debits. And just like we did in prior transactions when Eli's Consulting issued a check, we need to decrease our cash account because cash is an asset and assets decrease with credits. Therefore, we'll credit the cash account for $8,000. We've now recorded all of the transactions for November, and we can calculate the account balances for all of the accounts that have transactions. So how exactly do we do that? Well, we would add the numbers on each side of the account and enter the sum in the small pencil figures called the footing. And in practice, this is not really done anymore because typically most businesses use software programs and the system will do that for you automatically. But it's good to practice the theory. Subtract the smaller total from the larger one. And the result is the account balance. The total is recorded on the side with a larger amount, and usually the account balance appears on the increased side of the account. What that means is that, for instance, for assets increase with debits. So typically that's where the balance would be. And we also refer to that as the normal balance. So let's take a look at the cash account. We had an increase in cash from the investment from Trade & Eli of $100,000, and then 4 transactions that decreased the cash account for a total of $17,000. Writing the amount of $17,000 is called the footing. And then we'll calculate the balance, which is $100,000 minus the 4 transactions that decrease the cash account for $17,000, leaving us with a balance of $83,000. We do the same for the other asset accounts, and you can see that the supplies account has a balance of $1,500, and we don't need to calculate anything for this account because there's only 1 transaction. Same thing is true for prepaid rent. And we can see that the balance is $8,000. For equipment, we have 2 transactions, so we'll calculate the balance by adding those 2 transactions together, and we'll do the same for the liabilities. We had increases in liabilities of $6,000 and $3,500, and a decrease of $2,500, leaving us with a balance of $3,500. Next, we have the investment by Trade & Eli as an increase to the owner's equity account. Once we've done all this, we can prepare the balance sheet. We don't have any other financial statements that we're going to prepare at this point because no other transactions impacted any of the other financial statements. So, all right, let's start with the header of the balance sheet. So a balance sheet header has, as we discussed in Chapter 2, the name of the business, the name of the financial statement, and the time period. On the left side, we have the assets listing of the cash, supplies, prepaid rent, and equipment. The assets total $103,500. On the liability side, we have the accounts payable of $3,500 and owner's equity of $100,000. Also, the liabilities and owner's equity total $103,500, which confirms that our equation still holds true. Assets equals liabilities plus owner's equity. We're now ready for the next 6 transactions, starting with the 7th transaction where the business earned $36,000 in revenue from clients who paid cash for bookkeeping, accounting, and consulting services. So it looks like our cash increased by $36,000. Cash is an asset, and assets increase with debits. Therefore, we're going to debit cash for $36,000. Our revenue increased as well. We're using the account fees income. Fees income is part of owner's equity, and owner's equity increases with credits. Therefore, fees income increases with a credit of $36,000. Eli's Consulting also earned $11,000 from various charge account clients. So in contrast to the prior transaction, we're not receiving cash, but we're receiving something almost as good as cash. It is still an asset, and it's called accounts receivable. Accounts receivable is an asset, and it increases with a debit, and therefore we're going to debit accounts receivable for $11,000 on the left side. Every accounting transaction must have at least 1 debit and 1 credit, and we just recorded our debit to accounts receivable, which means that we now need to record the credit side for this transaction. In this transaction, we need to also record the increase in fees income, and just like for the last transaction, fees income increases with a credit of $11,000. For our 9th transaction, the company received $6,000 on account from clients who owed money. Basically, the clients who received services from Eli's Consulting for $11,000 previously, but did not pay cash, are now paying part of the amount. So two things are happening. Eli's Consulting's cash is increasing by $6,000, and accounts receivable are decreasing by $6,000. So we'll record a $6,000 debit to cash and a credit to accounts receivable of $6,000. Now, our 10th transaction, Eli's Consulting is paying $8,000 for salaries. There are two things that happened here. Salaries expenses increased and cash decreased. So let's start with the first part of the accounting transaction. Salaries expenses are part of owner's equity, and when salaries expenses increase, they decrease owner's equity. And owner's equity decreases with debits. Therefore, we need to debit salaries expenses for $8,000. As a reminder, all accounting transactions have at least one debit and at least one credit. Now that we've recorded the debit for this transaction, we need to record the credit. Eli's Consulting paid the salaries in cash, which means that cash decreased. Cash is an asset, and assets decrease with credits. Therefore, we need to credit cash for $8,000. Next, Eli's Consulting is paying utility expenses for $650. It's pretty much identical to the prior transaction, except that we're using a different expense account. But the concept is the same. Debit utility expenses for $650 and credit cash for $650. For our 12th transaction, though, this is not an expense because Trayton Eli is essentially just taking some of his investment back out of the company. So the company now owes him less money. Withdrawals are funds taken from the business by the owner for personal use. So let's analyze this transaction. Our cash decreases and owner's equity decreases as well. So we know that a decrease of cash is recorded by entering a credit into the cash account of $5,000. And now that we know the credit for this transaction, we're looking for the debit. Our owner's equity is decreasing, and for the owner's withdrawals, we use a special account called Trayton Eli's drawing. Why don't we just use the capital account? Well, when we prepare the statement of owner's equity, we'll need to list the owner's withdrawals on a separate line. And that's a lot easier to do when we're tracking the withdrawals in a separate account. So let's debit Trayton Eli's drawing account for $5,000. Again, we'll foot and sum all of our T accounts, first on the asset side, then for liabilities, and then for owner's equity accounts. And we're now ready to move on to our trial balance. What's the trial balance and why do we prepare a trial balance? Well, it's basically a quick overview of our account balances and our T accounts into which we've recorded our business transactions. The trial balance is a statement that tests the accuracy of total debits and credits after transactions have been recorded. In practice, you would run a report that is called trial balance in your accounting software program. And if the total debits do not equal total credits, which happens frequently in manual accounting, which is what we're doing here, we need to go back and fix our entries. In an accounting system, the total debits always equal the total credits in the trial balance because that is checked automatically. You wouldn't actually be able to record a transaction that doesn't balance. But as we're practicing accounting, it will happen to you all quite frequently because you'll forget to record one side of the entry or transpose a number. So here are a few tips for finding what transactions you might have recorded incorrectly. If the difference between debits and credits can be divided by 9, there's a transposition error. Like for instance, 45 versus 54. So if the difference between your debits and your credits is divisible by 9, that means that you've transposed something, meaning for instance, you entered $3,500 on the debit side and $5,300 on the credit side. The difference between $5,300 and $3,500 is $1,800, which is divisible by 9, and that would therefore be a transposition error. A slide occurs when the decimal point is misplaced. So you've entered one side as $375 and the other one as $37.50. Those are the two typical errors that you might find. Other errors would be, for instance, you recorded debit but forgot to record the credit. That's typical as well. That's why after the trial balance has been prepared, we double check that the debits equal the total credits. And so now we're ready to prepare the financial statements. So don't forget that important step. Double check that your debits equal your credits. So what do we prepare first? It's always the income statement that comes first. Why? As a reminder, we need the net income from the income statement to complete the statement of owner's equity, right? You can't prepare the statement of owner's equity if you don't have the net income, and you can't complete the balance sheet without knowing the ending balance from the owner's equity. So it's important that you have that. So let's start with the income statement. We go back to our trial balance. We enter the fee income from our trial balance. We enter the expenses. We subtract the expenses from the revenue and come up with net income. Okay. We next prepare our statement of owner's equity, which requires us to start with the beginning balance of the capital. As of December 1st, we have $100,000. We add that to our net income of $38,350 from the income statement. We subtract what Trayton Eli already took out as drawings. And we then combine net income less the withdrawals and then add that amount to the beginning balance, coming up with an ending capital balance of $133,350. Now we're ready to prepare the balance sheet. We first list out all of our assets, cash, accounts receivable, supplies, prepaid equipment, for a total of $136,850. We list our liabilities on the right side, starting with accounts payable of $3,500. We then list owner's equity, another form of liability that the business has. And we enter Trayton Eli's ending capital balance of $133,350, which we got from the statement of owner's equity, for a total of $136,850. We again see that our accounting equation holds true. Assets equals liabilities plus owner's equity. $136,850 on one side and $136,850 on the other side. I hope this was helpful. Keep practicing and reach out to me if you have any questions.